should we care about inflation in the Eurozone, or is the Fed the only thing that matters for financial markets? That's what we're going to focus on today. And needless to say, the argument that we're going to be putting forward here is going to give Eurozone and German inflation numbers that we have coming up this week a bit more credence than irrelevance, or we wouldn't be talking about them. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And we're going to have a look at this little indicator here and consider why the way that markets react to what is going on here might well be a very telltale sign, not just for the euro, not just for the Eurozone or Germany or for currency markets, but why it might be a critical piece of evidence for how stocks are going to perform, for how other markets are going to perform going forward, by defining that which the markets care about and the lens through which they view incoming information. So, first, let's see what's coming up for this data, how it might influence the markets, and from that perspective, see what the actual impact could be across assets, be they stocks, be they currencies, etc. So, we begin here with the expectations. And the first piece of this data this week is going to be German CPI inflation. The region-wide Eurozone number comes out the day after, but Germany is usually the main event because, of course, it is the largest economy in the Euro area. And as Germany goes, inflation trends-wise, so too does the Eurozone by and large. So the main event here is going to be the German release. I should also note that we're looking here at harmonized CPI. There is the German version of CPI data that is produced using the methodology that Germany likes for domestic purposes. And then there is the harmonized CPI number that is used by the ECB to be able to look at all of the member states that go into the euro and the inflation dynamics in each one with a single yardstick so that they can set a single currency and a single monetary policy for the group. Since what we care about is the ECB and monetary policy and the extent to which it powers stocks and the extent to which it drives currency markets, we're going to be looking at the harmonized version. The difference with the German version is really a level difference, not a direction difference. So, looking at this harmonized HCPI, we see that the expectation is that it is going to decline to 2.5% in November, which would essentially bring Germany within a hair of the ECB's target of 2%. Obviously, very encouraging. The core number is expected to come down as well. Obviously, we'll see what the makeup here is going to be once the numbers actually cross the wires. But from the looks of it, it seems like what we're looking at here is broad-based disinflation. At this point, the services and the goods side of the picture are about equal contributors, goods a little bit more than services, because food still seems to be the main current contributor to inflation in Germany. So 1.6 of the 3% that we got in October was due to goods and mainly food. 1.4, so slightly less, was services. As we look at what might happen here, the question starts to be, well, if this goes down, then we probably have status quo and all is well. We continue to expect the ECB to be done with raising rates. However, there is a case to be made for an upside surprise. We got numbers out of both the Eurozone and Germany from S&P Global, giving us November's Purchasing Manager Index surveys last week. And they suggested that we actually saw a pickup in both input and output inflation, both in Germany and the region as a whole, in November. And that, in fact, it was the service sector where the pickup came. Goods continued to disinflate, but the service sector surprised with stronger inflation because the impact of wages was really starting to make its way in and make its impact felt, much as it has in the US and the UK. So there's a risk here, looking at the PMI data, that we don't continue to see disinflation and that Eurozone CPI actually edges up with Germany out front. If we look at the way that economic data out of the Eurozone has performed recently, this is data from Citigroup, we can see it still tends to underperform relative to forecasts, but the margin has significantly diminished since the middle of the year. So data is getting increasingly better relative to forecasts. It still tends to undershoot, but by an increasingly small margin. And what that is telling us is indeed that there is possibility that this particular data outcome is going to give us something of a positive surprise. Obviously, if that's what occurs, the kind of textbook immediate thought that comes into one's mind is, well, if inflation is higher than people expect, the ECB, in investors' mind, in their outlook, will start to look like they have less scope for rate cuts. And so the outlook for ECB policy might get less dovish as a consequence. To sort of anchor ourselves where we are on ECB policy expectations, we can see no further rate hikes are expected at this point. We're looking at about a 50-50 shot of a cut in April, but that cut is fully baked in by June, and we're looking at about 2 with optionality for a third cut over the course of the year. We can see by October, the likelihood of a third cut is already 77%, so a good deal better than even, which suggests that by year end, by December 2024, we probably get 3 full cuts out of the ECB. And so we're looking at the shift here, 75 basis points starting mid-year. That's where the baseline is. If the CPI were to surprise higher, maybe we get a later start. So maybe the likelihood in April comes down. Maybe we shift that across the meetings that follow. So we still get probably the cut in June, but maybe it's more like 2 cuts with less of an optionality for a third rather than where we are now. So perhaps that's the move. Okay, what would that mean for markets? And this is where the controversy arises. If we consider what has been happening with the euro and Eurozone stocks over the course of November, what we are seeing is a kind of deja vu, especially for the euro, relative to last year. The euro is on pace for its best month since exactly 1 year ago, November of 2022. It's close to having a 4% month here. Exactly a year ago, it added 5.25% thereabouts. Now, what's interesting is that this rally in the euro has occurred even as the ECB has looked more dovish. So we just saw that the expectation was no more rate hikes. Well, the last time the ECB met was on October the 26th, and sure enough, the markets took that to mean that the rate hike cycle is over. Well, the euro rallied after, as we can see here, which is not typically what you would expect to see. Because, of course, when a central bank becomes more dovish, when it starts to more so look likely to cut than hike rates, that undermines the yield that is to be had on owning that currency. One person's cost of borrowing is another person's lending income. So if interest rates go up on a given currency, on borrowing a given currency, and you own that currency, that's more of a yield income that you can earn on lending it. And so the yield then that confers on owning that currency is higher, so the currency looks more attractive, so people buy the currency, it goes up. It goes the other way if interest rates are shifting such that markets now expect cuts. If interest rates are going to be lower, that's less of a return on owning the currency. Currency typically goes down. This seems to be taking that whole idea and turning it on its head, which seems, of course, unusual, and starts raising questions. Is the market actually rewarding the euro for a dovish ECB? There is a reason why that might be the case, as a matter of fact, because if global growth is indeed slowing, and the PMI data would suggest that it has essentially stopped as of November, and of course, global central banks had this exact thing in mind after a blistering year and a half of raising rates. So inflation is coming down, growth is grinding to a halt, all as expected, all as policy has been attempting to engineer. Then the greatest pain has been in the Eurozone. They're ostensibly in recession already. The U.S. is slowing, but still growing. China, even, despite their aborted attempt to try to juice growth with the end of zero COVID restrictions, even that reopening fizzling and coming apart has left China growing a little bit. But the Eurozone is shrinking. So perhaps the market is reasoning that if everybody is going into a recession together, then the first one to come out should be the beneficiary, since nobody is going to be left unscathed. And if the Eurozone is already in recession, well, first in, first out, perhaps. If the pain arrived earlier in Europe, then the ECB will cut sooner. Then the Eurozone will emerge faster than North America or Asia. So one might favor buying European assets, and to do that, you need euros. So perhaps the market is actually rewarding the ECB, saying, oh, good, you will provide the healing salve first. Let's go buy euro-denominated assets. That's driving up the euro. There is some evidence to suggest that is, in fact, the case. Here's the iShares Eurozone ETF. It tracks a broad index of Eurozone stocks. As we can see here, it surges after that October 26th ECB meeting. So there is definitely something to this idea. And in fact, Eurozone stocks have outperformed U.S. stocks. They've outperformed stocks in emerging markets, certainly in China, but even more generally in emerging markets, from this bottoming in global stocks at the start of November. So there is some logic here, clearly. This ETF, by the way, the ticker is EZU, as you can see on the chart here. And in fact, here we have ECB policy expectations. They did, in fact, shift more dovish. The big dashed line is where they were with the last ECB meeting on the 26th of October. We can see where things have shifted since then. The solid line is where they are now. The little dashed line is where they were a week ago. So not only has the ECB policy outlook become more dovish relative to when they last met, it's even become more dovish relative to a week ago. So we're looking at a situation here where it seems like the euro is reveling in a dovish shift in policy. So if CPI is going to be higher than expected, well, maybe that actually hurts the euro and doesn't help it, because it hurts stocks, because it hurts the case for more ECB stimulus. Maybe. Or it could be something else entirely is occurring here. Now, it certainly seems to be the case that Eurozone stocks are outperforming because the market is, in fact, cheering for a dovish ECB and looking at ECB policy changes as likely to encourage a better performance out of what is already a downbeat region. So that EZU ETF, it's up 13% since the beginning of November, whereas the S&P 500, let's say, is up under 11, 10.7. Global stocks as a whole up 10.4. Emerging markets are up 8.7. China is up barely 2%. So we're in a situation clearly where the Eurozone stocks have in fact outperformed. But the story with the euro doesn't seem to stop there. Here is a chart of the euro in the blue, and in the red are Fed policy odds. That red line is telling us where rates are expected to be in the U.S. December of next year. In other words, they capture what is the outlook for next year's Fed rate cut cycle. Note what is going on here. The euro does, in fact, start to bottom, and it does, in fact, rally after this ECB meeting. So it is certainly the case that a more dovish policy outlook for the ECB is coinciding with a higher euro. But this is where we have to remember that correlation is not causation. If we take a look here, we notice that the euro bottoms as Fed policy expectations top, and that the real meat of this rally, where it actually is triggered, follows the FOMC announcement on November the 1st, which, as it happens, follows just on the heels of the ECB. I mean, this is right back to back here. So, what's going on here? Is it, in fact, that the market is rewarding a dovish ECB in lifting the euro, or is the euro going up for a different reason? Well, we've seen this chart before. We know that the Fed said in September, with its summary of economic projections, that it needs about 50 basis points more, or 50 basis points higher rates than it thought in June, and the markets responded by a sharp bidding up of yields, even as they kept the 2-year yield anchored because they thought the Fed was done raising. Their perspective of, yes, but the rates will remain higher for longer, ended up with a jump in term premium for the long end of the curve, because, of course, nobody knew exactly what longer meant. And so while higher had probably been reached, it was unclear what longer constituted after the September Fed meeting. That jump in rate policy uncertainty ended up as a rise in term premium, so the additional return that markets demand in order to lend over a longer period of time, because ostensibly they now see more uncertainty there. That drives up the 10-year yield. it all changes with the November Fed meeting, where the Fed says, okay, we probably have seen as much of a rise in yields as we need to get the 50 basis points that we're looking for, and signaled that they're essentially done. Notice that's the point where yields top and break lower at the longer end. Uncertainty, which is the term premium here in the yellow, starts to deflate and is now at this point back to negative. And rate cuts start to make their way into the story. Right here, the Fed is holding higher for longer. Right here, as we start to see rates push lower here on the 2-year yield, that is the beginning of an easing cycle that seems to be getting baked in. And so we can see here that since the November 1st FOMC, as with the ECB on October the 26th, the curve has shifted down. So we see that the current curve here is more dovish than it was when the Fed made the announcement, and more dovish than a week ago. So we've seen negative or dovish, as it were, shifts in rate policy from both the Fed and the ECB around basically the same period of time. We can see why that has impacted U.S. stocks. We can see here, again, as the amount of rate cuts expected between December of this year and next, so again, next year's easing cycle, as it got smaller with easing concern about the SVB banking debacle in the first half of the year and the debt ceiling one immediately on its heels, fewer rate cuts, lower stocks in the U.S. But what happens as October turns to November is that turns, ostensibly with the Fed's November 1 policy meeting. The end of the cycle is seen. Rate cut expectations start to rebuild. What do stocks do? They surge. Makes sense. Borrowing costs are going to be lower than they were expected to be at the start of November, hence the shift. Lower borrowing costs means financing earnings will be easier. That means businesses face less of a hurdle than earlier expected to finance any kind of business activity. And that, of course, is good for equities. So what you get is a stocks rally, a blistering one, as a matter of fact. But it doesn't stop in the U.S. And this is where the connection to Europe really starts to present itself. We know from data published by the Bank of International Settlements that the daily turnover in U.S. dollars so vastly outstrips any other currency. And I've made a little bar here for the BRICS because, of course, there's been this recent de-dollarization conversation talking about maybe the BRICS currencies are going to try to challenge the dollar, just to highlight how ludicrous of an idea that is, how small these BRICS currencies actually are, and their utter inability to be the vehicle of exchange on a U.S. dollar scale. This is daily turnover in billions. So we're somewhere between 6 and 7 trillion on U.S. dollar turnover. And the euro is the next closest up at just over 2. So it's not even a contest. In fact, the Bank of International Settlements estimates that it's about 88% of global monetary transactions that are settled in U.S. dollar terms. Of course, we already know that most global commodities are traded in dollar terms, but also most financial transactions are lubricated through the dollar because the SWIFT correspondence system is fundamentally dollar-based. That's interbank correspondence, the way that banks move money between themselves, which, of course, is the overlay to all global economic activity. And so when the Fed cuts rates, what it's doing, or when it's expected to cut rates in this case, what's going on is that it is expected to make borrowing the dollar cheaper in the future rather than more expensive. And because the dollar is such a dominant force in global commerce here, as we can clearly see, when you do that, what you're doing is lowering the cost of borrowing, not just in the US, but everywhere, with very few exceptions. Let's say an economy completely cut off from global markets, like a North Korea, might see this more muted. But generally speaking, this influences the situation everywhere, which is how you then get a stocks rally, not just in Europe, not just in the US, but everywhere. And so surely there is something to European stocks outperforming. But what you see on this chart here, which is the MSCI World Stock ETF, so this is global equities, not the US, not Europe, but everywhere. ACWI, the All Country World Index. What you see here is, yes, you start to bottom with the ECB, but the meat of the rally is the Fed. It's the Fed reducing borrowing costs for everyone, or expected to, that is powering risk here. Now, sure, it's very possible that the European stocks are outperforming amongst this broad-based rally because the ECB is seen as more dovish. But the story for the euro could be quite different. As a matter of fact, since we already know policy expectations shifted more dovish for the ECB in November, we saw that here. So this was the meeting. This is the line now. So the shift down, that's dovish. We know the same thing happened for the Fed. Here's the Fed curve. Again, here was the meeting. Here's the Fed line. There's the shift. More dovish. It makes sense to look at these in relative terms. So this is the difference between those curves. We can see here that currently the ECB is behind the Fed by about 1.4% or 140 basis points. That this differential is going to hold for the next year, give or take, because the cutting will happen at about an analogous pace. But that thereafter, the ECB's yield disadvantage shrinks over the course of the subsequent 2 and out to 3 years by almost 50 basis points. Almost 0.5%. And so while there's been a dovish shift for both central banks, there's been a greater one, it looks like, for the Fed. And so in relative terms, all of these things have actually ended up looking like a better yield profile for the euro. So it's not necessarily the underlying capital flows that see the euro outperform because your Eurozone stocks are outperforming. It's that the shift at the Fed is being more impactful than the shift at the ECB. And in relative terms, that's given the euro a bit of a yield advantage when you look far enough out. And of course, if it's stasis until then, that's what matters. With that in mind, if we get this CPI data coming up hotter than expected, the euro might actually rally. And that could give us a window into the way markets perform for the next 3 to 6 months. Because what it would suggest is that it's not dovish central banking that is being rewarded by the markets. That currencies still primarily care about yields. Only the central bank that matters is the Fed and really not any other one. And so watching where yields are going in the US will continue to be the defining story about stocks, will continue to be the defining story for all the major currencies. will continue to be a defining story across all the other assets, because what is moving is the global cost of credit. And as long as the global cost of credit is relatively on the Fed side of things, expected to come down because the Fed is expected to be more dovish, we are likely to see a risk-on environment, as epitomized by what we've just seen in global stocks. But if you get a day like today, where interest rates are down, the dollar is down, the yen is up, but stocks can't rally, you get a conversation that starts to really worry one about whether a rise like this remains sustainable as the focus starts to shift to global recession risk. And in that global recession scenario, it isn't that markets are being rewarded by dovish central banks or for having dovish central banks. What this German CPI response in the euro might tell us is that markets care much more about why those central banks are getting dovish. And recession risk might overtake as the driving narrative for markets. And that is Macro Money for today. As ever, we are here every day, Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, where we look at what happened on Wall Street and try to figure out what it means going forward. I am also on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com, and opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money will be back tomorrow. Happy trading. Take care.